And I'd like to welcome everyone to today's webinar. I'm Shannon Dill. I'm with University of Maryland Extension. We're happy to have you here today to talk about planning for retirement. Just a little bit about the webinars. You can go here to the blue link to see archived webinars as well as upcoming ones. We have them scheduled through the end of December. We'd like to thank our sponsors of the Women in Ag program, as well as all the collaborators that we work with. Through today's session, if you have any questions or comments, please feel free to use the chat pod and we'll answer those at the end of the day. So we're going to go ahead and turn it over to Jesse and Maria. I'll let them introduce themselves and thank them very much for being here today to present.
Thank you, Shannon. We're really glad to be here. And today's session is really about planning for retirement. And our presenters here today are myself, and I'm Maria Papitas, and I'm with the University of Delaware Cooperative Extension. I'm a family and consumer science educator with a focus on family financial management, and I'll let Jesse introduce himself.
Thank you, Maria. My name is Jesse Ketterman. I'm also with University of Maryland Extension, same as Shannon, and I am in the Western Cluster of Maryland. So I Frederick, Garrett, and Allegheny counties, and my focus is financial literacy. So I'm also a family and consumer science educator, same as Maria, and I'm also an accredited financial counselor. So as we get started, I'm also going to put a quick link in the chat box. Maria and I need to collect some demographic information for our presentation today. So if you could click on that link and complete the 4 or 5 questions, we would greatly appreciate it. And I'll turn it back over to Maria.
Thank you. So our overview for today, what we're hoping to present to you is really kind of a better understanding of income and savings needs during your retirement. So this is a good way to kind of get ready and start your thinking and planning for your retirement years. So we're going to introduce you to something called the Ballpark Estimate Worksheet and talk a little bit about how do you begin to think about planning for retirement financially anyway. And we'll talk a little bit about some savings options and some strategies for late savers. So, what is kind of succession planning and how does retirement planning kind of fit into that? They are related, and so it's a process of really thinking about not only what am I thinking about from a retirement side, but also what does that mean in terms of the big asset of the farm, if that's something that you have. And so it's really the process of ensuring that the business is continued throughout the generations, but it can have a really big impact on retirement. And so let's just take a look at how those overlap. And so when we think about kind of that succession plan and where does retirement fit in, this is something that I kind of pulled together because it is as I said, it's sort of overlapping of different pieces. And so farm families are very unique in that way. Because you have the business, right? You have the farm business, but it's also a huge asset in terms of land and property and equipment. And, there's that piece around estate planning and there's the piece around retirement planning and how does that connect back in with your business as you age. And then what does that mean for succession planning? And so, that little diamond in the middle is kind of about some of those documents that you need to think about and prepare, and also putting it into the kind of a broader context of the family, thinking about how do we plan, how do we talk about it, how do we create transparency between the business partners as well as within the family. And then, how do you find the right advisors? So it's a bigger picture that retirement planning is a part of. So let's just focus in then on retirement. So it's really important for you to think about what you want your retirement to be, and you want it to look like. And so by answering some of these questions, where will you be living? How will you spend your time? Who's going to be around you? What are those leisure activities that you want to pursue? Oftentimes we put off, because we're so busy working, we put off some of those fun things, I'll just say, or the big bucket list things that you might want to do. And so what are some of those things that you really want to have and make happen, that is going to make you happy in your retirement? And then how does that relate to who's going to be running the farm? And so thinking about stages of retirement, and because there's a couple of stages, and we'll talk about that in a second, but what is that big picture? And it's really important to have a sense of what that picture is in your head, because that is going to help drive and help you estimate what your needs are going to be in retirement. So the literature really helps us look at, what we know about kind of stages in retirement. And so what we have experienced, especially now that folks are living so long, there's about 6 stages of retirement. It's amazing. And so it's the time kind of before you retire where you start thinking about it, and you're trying to, you're in that life stage where you're reflecting, what have I done? What do I want to still do? And so we're in that pre-retirement stage, and then we kind of move into that retirement time, where it's sort of like immediately right after retirement, when some people really, okay, I'm shutting the door. I'm not going to do this anymore. I'm not working anymore. And so there's this kind of honeymoon period right after retirement, where there's that rest and relaxation. And honestly, the research is saying that's an important thing. And I think that that's one of the things that's hard for farmers, especially if they're living on the location of the farm, to kind of like let go a little bit and just sort of ease into that retirement. The next stage is this notion of disenchantment, like, oh gosh, what am I going to do next? How am I going to spend my time? And I think, again, this is kind of tough for farmers, especially if they're living on their farm, because there isn't a detachment, right? And so in your boredom, if you've turned things over to your heirs who are taking over the farm, there may be some a time of disenchantment, of like, did I do the right thing? Don't they still need my help? All of those kinds of things that go on in your head. So then it comes to a time of reorientation, like, what is my role going to be, and how am I going to support the farm, but also be retired? And then coming into some sort of routine, and then kind of that last stage, which I think they kind of humorously talk about it being the termination of retirement, which I think is really when we pass away, right? when we pass over. So so thinking about all those stages, and how fast they come, and how long each stage takes, that is by individual, right? All right, next slide, please. So we know that retirement takes money. It all sorts of things, right? The housing and healthcare, transportation, communication, clothing, leisure, gifts, contributions. Those things that we want to be doing, and certainly insurance premiums. And all of it takes money, and it gets a little bit more complex, especially those who are living on a farm, living in the place where their farm is, and some of those farm and household expenses are kind of overlapping. But it's important to get a handle on all of that, because it does take money. So how do we begin to estimate our expenses in retirement? And there's really kind of two approaches. One is we kind of use some sort of financial calculator, and we're going to talk a little bit about that as we kind of go through the rest of the presentation. And the other is really to crunch your numbers, right? To really look at what's happening now and to begin to think about, well, how might those expenses change as we, as we age, as we, get into retirement and beyond. And so one of the things that we did send you in that packet is a worksheet that you could use. And Jesse, if you could do the next slide, thank you. And so here is that worksheet, and you can see there's a whole bunch of expense categories down the left-hand side, and then two columns, right? And so the first column is really about what's happening now. What are some of those expenses now? And then the other is to kind of do some cost estimates of what it will be in retirement. So for example, I currently have a car payment, and I am hoping that by the time I retire, I do not have a car payment, right? And so that might be a situation where, things will considerably change, right? Another area might be health insurance. So currently I have health insurance through my employer. When I hit 65, right, that's going to change a little bit because I'll still have insurance through my employer, thankfully, but I'll also have Social Security. And so there will be some changes then in terms of how much I am spending on health insurance. And so I apologize. I said Social Security, but I meant Medicare. So sorry. So again, it's looking at some of those things that you anticipate may change and some of those things that may not change at all. So go ahead. That's one tool, right? Is kind of calculating it on your own. So the other way is kind of through some sort of financial calculator. And so one of the tools that many financial planners use is kind of looking at where your money is already going or based on your income. And so looking at what's your income and then taking a percentage of that as kind of a guide for anticipated changes in spending in retirement. So these are some of the I'll just say percentages that some financial calculators and financial planner counselors might use as they work with you to try and figure out what your retirement savings needs may be. So you can see it goes anywhere from 70% to, more than what you're making now. And that is based on your goals, right? So if I am going to retire and then, I don't know, travel the world, maybe I need a little bit more money in my future than I do now, right? So that's where that 100 to over to 120% of current income figure might come from. But again, it's based on your goals and what you're hoping to accomplish when you're in your retirement. So for any retirement planning estimate, there's some important pieces of information that you need to know. And one of them, of course, is what your Social Security benefits might be. Another might be is if there's going to be any pension from your employer and or part-time income. And for many farmers, as they continue to kind of farm in retirement, there may be some part-time income that's coming in. Other pieces that are important to help calculate is this estimate of the income needed in retirement, which we just talked about. Another critical piece is how much you've already saved. And lastly, how long you think you'll be in retirement, which really gets to longevity. How long do you expect to live? So those are the key kind of pieces of information that are especially used when you're using some sort of financial calculator. So one of the key resources that we wanted to make you aware is that you can find out what your potential Social Security income can be. There's some resources on the web, and so these are the websites that can provide you that information, as well as provide some videos to help you better understand it. These resources are also in that list of resources that we shared with you as part of the handouts for today. So we encourage you to go and take a look at that. But you know, as you know, we in the old days, and I can say that because I'm one of them, we used to get a statement every year from the Social Security office to sort of say, you know, here's how much you contributed, here's what your expected monthly Social Security check may look like. So depending on how old you are, you may still get that annually. For those of us who are a little bit younger, we may not be getting it in the mail, but this website allows you to find out anytime, right? And I see Jesse's turned his video on. I'm sure he has something to say.
No, I'm just ready to, I know I'm the next slide, so if we're ready to transition.
Okay, all right.
Just get warmed up.
All right. He's warmed up and ready to go. So anyway, we encourage you to go and find out that information. That's a really critical piece and is easy to do and is secure, so you can find out that information. All right, now I'll turn it over to Jesse, who's going to take us through the next part of our session.
Thank you, Maria. And this was, again, in part of that advanced packet that we have. It's called the Ballpark Estimate Worksheet. It is something developed by the American Savings and Education Council. And, you know, it's an exercise, and it's going to give you a basic idea of the savings you need when you retire. So it's going to be a ballpark, right? It's not going to be specific or exact, but it's a tool that you can use. And we're going to walk through it with a case study and give you a good idea of how you could apply it to your particular situation. So as I kind of mentioned, there are some limitations. It's a great tool, but it is an estimate. And so, you know, it kind of makes some assumptions. What your earning assumptions will be on savings, what your Social Security benefit projections will be. You know, you have to choose your life expectancy. So you got to kind of say, this is how long I think I'm going to live. It does allow you to look at early retirement. And then it does have an assumption that the wages will increase with inflation. So those are some of the assumptions that we have going into completing this worksheet. There are some limitations. So it does reflect today's dollars. And so this might be something that you want to do on a regular basis. You might want to do this annually or every other year, depending upon how close you are to retirement. And, you know, you also have to know that your circumstances changes, right? If the market changes and your savings drop significantly, or it increases and jumps significantly, those are things, again, that just reinforce why you want to do this on a regular basis, just to kind of give you an idea of how things change over time. And, you know, if you're less than 10 years from retirement, this may not be the best tool for you, so you might want to look at some other tools that are out there. But this is a good tool to give you again, like it says, a ballpark estimate. And like I said, we're going to be working through a case study here. There are some other tools you might want to check out from the American Savings Council, and you can see that here. Their website is www.asec.org/tools. You can see that this ballpark estimator is under construction. So if you went to their website for this particular worksheet that we've provided you with, you may not find it because it's still under construction. So, but we did send that to you, and it's also available on the web link associated with this presentation today. And so you're going to need some additional information here. So we're going to look at a case study with Masha and Ben. But you do need to know that you know some things you need. You need to know the total amount you need to save and the annual amount you need to save. And then if you're married, you know, you'd have to fill this out with both parties. But we're going to walk through how you'll do this on the screen. And so let's just jump into our case study. So we have Marcia and Ben. You can see they're age 49 and 47. They have 2 kids in their teens. Marcia has some off-farm income and benefits. Ben makes $30,000 a year while Marcia makes $45,000. So their combined income is $75,000. They need, you know, their assumption is that they're going to need 85% of their income when they retire. They're going to plan to retire at 65. They've made their estimate on life expectancy at 87. And their current retirement savings are $170,000. And so, you know, they're going to need to kind of answer these 2 questions. How much will they need to save in total, and how much will they need to save annually to reach that total? And so let's start crunching the numbers here with the worksheet. And so if you have the worksheet, you can see where the questions here, 1, 2, and 3, just coincide with the worksheet. You know, the first pieces you need to enter is how much annual income is wanted in retirement. We made that assumption that they wanted 85%. Again, that's going to change depending upon what your situation and how you see your particular retirement. And so at 85% of their income, it's going to take Marcia to $38,250 and Ben to $25,500. And so if you remember, Ben is currently making $30,000 a year, and Marcia is making $45,000 a year. So again, you're multiplying that by 0.85. That's going to give you the figures you see on the screen. Then you go down to step 2, and step 2, you need to subtract the income you expect to receive annually from Social Security. So on the worksheet, it gives you some general guidance. You can also go to that site that Maria shared with you earlier to figure out an exact number there. So with our calculations, we figured Marcia is going to make $19,992 annually from Social Security, and Ben's going to make $15,780. They don't have any traditional employer pension plan. There was some assumptions there about part-time income and land lease. And so I think Ben was going to lease his land, and Marcia had some part-time income that she was going to have there. So Ben's going to land lease his and get that $1,200 a year. And then Marcia's going to have an online sales business, making about $125 a month, which will take you up to that $1,500 figure. And then you take those figures and subtract out, and this is how much you'll need to make. So we get to point 3 there. This is how much you need to make up each year for retirement. So we took that salary of Marcia's, the $38,250, subtracted out the $19,992 minus the $1,500, and that gives you $16,758. And you do the same on Ben's side, and that figure gives you $8,520. Then we need to do that estimate in terms of the amount you'll need to make up, multiply that amount by the factor below. So the worksheet gives you these factors. and you can see they are in the 75th percentile. And you take those factors, multiply it by those numbers. And again, we're just working down the worksheet here on the third step. And so you see the 16,758, which we had from the previous page, from step 2 multiplied by 18.79. That gives you the 314,000 figure. You did the same with Ben, and you get 147,000. And so now they have the total amount that they need to save, which is $462,705.
And I just want to add one thing, right? How do you know what your, like which column, right? And that has to do with your expected, what you're thinking your life expectancy will be, right? So we picked these two columns because of what they said, what Ben and Marcia said about how long they expected to live. So that's how you figure that out.
There you go. Thank you, Maria.
Yeah, no problem.
And so now you move to step 4 on the worksheet. If you expect to retire before age 65, multiply your Social Security benefits from line 2 and by the factor below. And so they're not doing that here, so we don't need to worry about that. Now you need to multiply your savings, which again, we figured that up to be $170,000 by the factor they have here, which in this case, they're 15 years from retirement, which would be 1.6. And you multiply that and you'd have the total amount needed down there at the bottom, minus the value of that $170,000. Times that 1.6 figure, which gives you $272,000. So you subtract out what they needed, which we figured out in one of those prior steps, subtract out what they have, and that leaves $190,000 or $190,705 additional money that they're going to need to save for retirement that they didn't think about, given the initial variables we had in this case study. So again, I know these figures and factors can be complicated, but the ballpark estimator worksheet just walks you through this. It gives you these numbers that you need. And so, if you have that in front of you, you're probably following right along. If you're not, you might be saying, where's he coming up with this 1.6 and so forth? This is all in the worksheet. So now we need to figure out how much additional money annually that they're going to need to save to reach their goal. And so they take that and you multiply that by that factor that they have there. And you can see if you take $190,705 and multiply it by that 0.052, you're going to get $9,917 a year, which they would need to reach their goal, their retirement goal. Or if you broke that down by a month, it would be $826. And so now we kind of get to where they're at. Marcia kind of figured in that she could increase her savings into her 401k with her employer that has a match, and that would make up $413. So we have the $826 minus the $413, which would be they would need to come up with another $413 a month, or $4,956 a year. So Ben needs to kind of come up with a plan for how he's going to make up the 413 or the other half of that 826. And so now we're going to jump into some different types of accounts where you might want to consider or things that Ben could consider where he could put his money to make up that difference.
So hopefully your mind isn't spinning with all of those numbers. As Jesse said, the worksheet really helps walk you through that. And now we're getting to a place where it's like, oh, so what are some strategies we can use? What are some tools we can use to help them save? And so the next couple of slides that I'm going to talk about are really what are some of those tools. So there's a thing called an individual retirement account, right? And an individual retirement account is basically a savings tool that doesn't have anything to do with your work, right? It is a savings account that under the IRS rules allows you to put money in and fund it and helps you support and grow money into the future for your retirement. And so individual retirement accounts can be invested in a number of different things. And so the IRA as a title is just it's just that. It's a title that sort of says, this is this kind of account that allows you to put money away tax-free until you retire. And so the only requirement to contribute to an IRA is that you have some amount of money or some amount of earned income, or have a spouse with some earned income. So it'd be very easy for Ben to open up an IRA. So some pros, right? They're really easy to set up. There's lots of options. And the focus is on taking money now, right? And putting the money into this account. And a regular IRA allows you to deduct the amount that you put into this account from your current taxes. And so an IRA lets you put what's called pre-tax dollars, right, away, and it grows and builds in that account. And then when you take it out, then the money is taxed. There's a different kind of IRA called a Roth IRA. And so it's the same idea. It's a savings account of some sort that you put after tax dollars in, and you put it into the account and it grows. But then when you pull it out, you can pull all of that money out without paying taxes on it. So both tools are excellent tools. They have their pros and cons. But the biggest con, I'll just say, is it really limits how much you can save each year. So for the Roth and the regular retirement account, go ahead, there we go. The annual contribution for 2021 is $6,000, but if you're 50 and older, it's $7,000. So what does that mean? So it means whether you have opened a Roth IRA or a regular IRA, you can be putting those amounts away each year. And like I said, the IRA, the regular IRA, you use pre-tax dollars. So in effect, it lowers your taxable income, whereas the Roth uses after-tax dollars. But as I said, then when you pull the money out later on, that money comes out tax-free. So anyway around it, that's $6,000 to $7,000 you can be putting away. There are other types of tools, right? There's an employer-based savings. So if you have your, since you have a small business, you could be setting up a 401k plan. So again, this is another type of retirement savings that you get to put even higher amounts away, right? So for 2021, the limits into 401ks would be $19,500 for an individual, or $39,000 for a couple. So I just want to say here what's the difference between a 401k and a 403b, or even a 457 plan. All of those come from the IRS lingo. Has to do with kind of regulations within the IRS rules. And so a 401k is affiliated with a for-profit entity, which would, your farm business would be that. A 403b would be for a nonprofit entity, right? So, it's important to know that, but I didn't want to confuse you by all of those little, numbers in there. And so also note that as there's a catch-up provision, right, for people over 50, we can be adding even more, right? We can be putting $26,000 away. That's basically all that Ben is making, right? So if they wanted to live on Marsh's income, Ben could be putting all his money into his retirement savings. $52,000 for a couple. So Ben could be putting away money depending on, how they set up an account for the farm business. But Marcia could also be putting a little bit more away each month through her employer plan. Okay, next slide. What about an individual 401k? So this is another tool that is offered for small businesses, right? And so this is something that Marcia and Ben could consider. As I said, it's for small business owners, and it's nice because the plan is flexible. It's a little costly to administer. But someone who is a small business owner who wants to put more away, it's a great tool to make that happen. And you could work with your tax advisor to kind of help set this up and make sure that that things within your business plan, right, and your business finances are being used to help contribute, right, to this. And by business, I mean your farm business. All right, next slide.
So
Go ahead.
I'm going to add, right? Yeah. Okay. So I'm going to add what Maria said there in terms of, this is something you want to talk through with your accountant, which of these strategies you think is going to work best for you, because I'm going to cover two more options on the small business side. Again, it's worth looking into to figure out which situation is best for you, and using an accountant is also going to have that knowledge of what may work best with your situation. But one is called a Simplified Employee Pension Plan, or a SEP IRA. Basically, it's a plan funded by your employer, and so you can see there the contribution limit in 2021 is 25% of the of compensation, or $56,000. It's easy and inexpensive to start and administer. The con is it's the sole responsibility. Funding falls on the employer. So therefore, it might be good for, again, a small farm operation with one or few employees. The next one you can think about is what's called a simple IRA. And you can see there's a savings incentive match plan for employees. It's tax deferred in retirement, and it's a savings plan for small business that the employer must contribute to on behalf of their employees. So you see this is the business contributing to an individual. There's the contribution limit in 2021, $13,000, or 100% of your income, whichever is less. And you can see there's a catch-up provision there. It's inexpensive and open to run as the pro. And its con is the contribution limits are low compared to some other plans. Again, it's good for the small business operations. And And so if you want to find some more places to explore these options, think about the IRS and choosing a retirement solution for your small business. And there's a publication with that there. And again, you can pull the slideshow up later on and identify that website. But it has lots of good information and plans. You can also contact some of the mutual fund companies that are out there. They have different options for small businesses. So Fidelity, Vanguard are just examples, but there's other ones out there. But looking at what's offered in those mutual fund companies might be something worth considering as well. You may also want to think about having a financial advisor. So, your financial advisor is going to be a little different than your accountant. Their background is going to be, and their experience is going to be a little different. So if you go out and seek a financial advisor, there's an association out there, National Association of Personal Financial Advisors. You do want to check someone's educational background and the experience they have. What are their qualifications and how do they stay current in the field? There's a certification out there called Certified Financial Planner. That might be something you want to look for. Ask them what services they offer, how they are charging for their services, right? So you want to make sure that you're not getting hit with management fees that are too high. Number 5, looking at, could anyone besides me benefit from your recommendations? And, you can always ask for things in writing. You might also want to ask them, are they tied to a particular companies that they work with, right? So they may limit their options to working with a particular company. And so, again, making sure you do your homework. I would also suggest that you talk to more than one financial advisor before you figure out which one might fit your situation and best work with you as a client. And I think I'm taking it back to Maria, who is going to talk about tips for retirement savers late in the game. And as she's kind of warming up. Okay, there she is.
Yeah. So some tips, right, for starting your savings. I guess I would wonder, how many of you already started your savings? Have you got some money accumulated already? We know that many people don't, and especially farm audiences, they are kind of land rich, right, and maybe a savings account poor. But that is also one of the things that can challenge a positive succession plan, right? I mean, if you are relying on the asset of your land and your farm business to carry you into retirement, then it's hard then to kind of create that legacy, and it's hard to pass the reins over to younger generations or other people who want to go into farming if you haven't prepared for your retirement. So it's really important to start saving and thinking about what are those pieces that are going to help to support you in your retirement. How much of it is going to come from Social Security? How much will come from land leases? How much will come from other parts of your business? And how much of it will come from savings? And so it's complex, but you need to be thinking about it, right? Especially if you're thinking that part of what you want to do is transfer the farm and the assets to the next generation. So kind of wealth accumulation, cash wealth accumulation needs to be a priority. And thinking through and mapping out your stages of retirement as clearly as you can, and trying to estimate those expenses for each of those stages is really kind of important. And you know, one of the things that I've read recently is this little quote down here in the corner, but I thought that this is really telling, because I think there's a lot of individuals and family members who want to support their kids to go through college and are saving for college tuition. Um, but that is also money that could be put towards your retirement savings. And this little quote came up, and I thought it was very telling and realistic. You know, an adult child can take a loan out for their tuition, but a parent can't take a loan out for your retirement. And so thinking about, you know, not that your kid's education isn't a priority, but also thinking about your own retirement and your lifespan, making that just as much of a priority. And we tend as parents to put our kids first. And yet, if you think about it, we probably want to be around and healthy and doing well so that we can watch our kids and our grandkids grow up. So putting that wealth and cash accumulation, you know, making it a priority is really important. All right. So some other tips, you know, you have to save, right? How you save can be as important as how much you save. And so we're introducing this concept of asset allocation, and asset allocation has to do with, you know, what are you investing in? And for many farm families, it's all about investing in the farm. But it can also mean investing in the kinds of retirement tools like mutual funds, as you know, savings accounts, CDs, those sorts of things that will help you have cash assets as you age. And so what is that? You know, I kind of think of it as a pie chart, right? Where of all of the assets that make up your net worth, uh, you know, how much of it is the land, how much of it is the equipment and the farm, and how much of it is some of these other tools that you can use to save for retirement. So here's a really great resource online that can kind of, if you're feeling like, oh my gosh, all these words, all of this is so confusing, it can be overwhelming. This is a great tool written by some cooperative extension colleagues who really know how to make the language easily understandable. So Investing for Your Future is a great tool. Another one is Smart About Money. Again, great tools to kind of get yourself familiarized with the language and the concepts, so that as you have conversations with those financial planners or accountants, you're feeling more confident. Again, here are some more resources. This list is in the resource list that we sent you previously. And so take a look at these. You can see that there are some that are specific to farming, as well as just, you know, general tools that would be helpful. So this is our opportunity to ask you all. Do you all have questions that we might be able to answer for you? You've got us for a few more minutes, and we're the experts. So Jesse can turn his video back on, and please feel free to ask questions. You can type them in the chat if you'd like. I've also put a link in the chat box for our post-program evaluation. If you wouldn't mind taking a few moments to go there, and take you less than 3 minutes to do that, that would be really awesome. So please ask away if you have any questions.
Hi, Maria. I'm just looking at the chat. I don't see any specific ones. You put some really good kind of thought-provoking questions in there. So yeah, if anybody has any questions, please feel free to ask those in the chat pod. All right, well, I'm not seeing any. What we'll do is we'll be sending out this slide set, which had some great resources in it. If you can email that to me, that would be excellent. And we'll also be doing, sending the recording as well. So I'd like to especially thank Jesse and Maria for being here today, sharing this great information, and thank everyone. And time to, we're all sort of doing some financial things right now. So this is a great time to sit down and maybe review your retirement plans, your resolutions.
Thank you, Shannon. Thanks for having us. And I know Jesse and I would be most happy to answer any questions if you want to send us an email. So
Absolutely.
thanks for having us, Shannon.
Thanks, everyone.